Now let's take a look at some indicators. You can see, I'll just do one on this, and then I'll do the MACD here and the stochastic on another. This is just what I would call a standard MACD, 12, 26, and 9. For those of you that trade a MACD, you probably know that that's a fairly standard setting. And the guy, I believe his name is Appel, who made the MACD, he espouses 12, 26, and 9. But in essence, what I look for on a 12, 26, and 9 setting is a histogram divergence. The histogram are these red and green lines here. I really ignore the crossovers. The crossovers come very, very late in the move in general. So what I look for is a divergence here with the histogram itself. That's my personal philosophy. So what I'm going to be dealing with here is the divergence, pure and simple. So we see the divergence here. There's price making a low. Here's price making a lower low, while the histogram is making a higher low. Very easy to see the divergence there. Price and indicator. Okay? Now, by way of educating somebody who doesn't know, this divergence here means it's what's called indicator divergence. It's generally said to be bullish for price, meaning price is expected to go up from here. So how can we verify this with our volume or our activity analysis? Well, first of all, what do we want to see? Well, we want to see as price is coming down. Now, this isn't something that's quite as simple as looking at a trend line, because a trend line, as you can see here, gives us a definite price. We have a pinpoint price at which to look at. An indicator really doesn't give us that option. With an indicator, the best we can do is see some type of indicator formation. In this case, we see the divergence here, and then go and look at price and volume retroactively. Okay? So it's not like we can look ahead and say, okay, as soon as price gets to X level, I'm going to verify volume. What we have to do is, as soon as the indicator looks like X, then I'll go and look at volume. Okay, just a slight difference. So let's take a look at this. Let me zoom in a little bit. We're going to focus on this day here and this day here, being that they're low days, and then we're also going to take a look at what happened here and probably here. But let's focus on these two down days first. This day here is the 23rd, right here. So we're going to look at this region of trading. What's going on? Well, first of all, what I immediately see, look at that, volume going up. What's going on with price? Down. Okay? Very, very basic, very simple. We don't need a lot of complex math. Now let's back this up. Remember our day in question here. We're looking at this spike. What's going on with activity? Well, even though we're only looking at, let's see, 1, 2, 3, 4, 5, 6, 7, about 7.5 sessions, pretty obvious that this is an extreme reading, huh? And this is the pound here. We're not talking about, some unknown currency here. So obviously price is spiking. As price is coming down, you can see volume is moving up. This area here corresponds with this area, wait a minute, wrong one, this area here. So we've got a 2-session up move. There's the 2-session up move. You can see that, 19th. So what happens to volume? Volume is dropping and then staying steady. And actually, well, let's look at this a little closer. Okay, let's not go back so far, because we're actually looking at, in this brief area, we're looking at price not only going up, we're looking at price coming down. So let's constrain ourselves to this area here.